This is your technical update from the LMAX Exchange Research and Analytics Desk for Friday, January 29th, 2016. Euro dollar. So it seems there's no reason to really commit in either direction on the euro right now, with the market confined to a well-defined range between 110.60 above and 107 below. At this point, given the broader downside pressure and the downtrend, the structure does favor a lower top at 110.60 ahead of the next downside extension below 107.11 and towards that 105.21 December low. But at this point, the market is still trying to trade up towards resistance, and if we do see a break back above 110.60, it'll compromise the downtrend and open the door for a more significant move higher. So wait and see the market to see if it breaks above 110.60 or 107.11 before any clearer directional insight. Sterling dollar. So cable continues with its recovery out from those recent 140.80 multi-year lows, and the market looks poised to extend higher, potentially back towards the 146 to 148 area between a key 50 to 61.8% fib retracements. At this point, only back below recent lows that we saw that come in at 141.70 about would take the immediate pressure off the top side while this correction looks to extend higher. Certainly after the market traded into deep oversold territory, there is room for a healthy correction in the sessions ahead. Any break back below that recent low, though, at 41.70 in the 141.70 area would put the immediate pressure back on the downside and negate the potential recovery, exposing a more immediate retest of that recent low at 140.80, which is the lowest level seen since March 2009. Dollar yen. So a break in dollar yen back above some key resistance at 20.65 today, with the market surging all the way up towards the 122 area. The market is stalled out at 121.40 at this point, but there is risk for additional upside. It will, however, be key to see how the market responds to 20.65 on a daily close basis. If the market closes below 120.65, then it suggests that this was a bit of a false break higher, and the market is still pressured to the downside, with a possibility for a resumption of declines back down towards and below recent lows that we saw going back to the 20th of January at 150.97. If, however, the market can establish a daily close back above 20.65, this will put the pressure back on the top side and open the door for a resumption of the gains in this market and a broader resumption of the longer-term uptrend. Euro Swiss. So Euro Swiss has finally broken out, and this market has shifted from being a range trade to a trend trade, with the market now trending higher, breaking above that key resistance from the September 2015 peak at 110.50. The break opens the door for the next measure move upside extension towards the 114 to 115 area. At this point, any setbacks that we do see should be very well supported into the 108s, while only back below 107.15 would compromise the bullish outlook for Euro Swiss. Aussie dollar. So Aussie is doing a good job of extending its recovery out from recent multi-year lows at 68.27, with the market trading back above 71 thus far. There is a possibility for additional corrective upside towards a key 61.8% fib retracement at 71.70, though ultimately any additional rally should be well capped into that level in favor of a broader resumption of the downtrend, a lower top, and a resumption of declines back down towards 68.27. Ultimately, only back above 73.85 would compromise the bearish outlook for Aussie dollar. Dollar CAD. So we're seeing dollar CAD break down today, with the market clearing and breaking below previous resistance at 140, which is now support. There's a lot of good support into this area in the 140s, but the market is still potentially seen heading lower, with this correction extending to some support at 138 further down. Ultimately, while the market holds above 138 on a close basis, there's risk for a higher low and a resumption of this strong uptrend back towards those near 13-year highs at 146.90 seen back on the 20th of January. A close below 138, however, would delay this bullish structure and open the door for a more meaningful corrective decline in dollar CAD. Kiwi dollar. So Kiwi is in the process of consolidating recent declines after coming under some intense pressure in early 2016. At this point, the consolidation is classified as a bearish consolidation, and if we see any rallies, they should be very well capped into ahead of 67 in favor of a lower top and resumption of weakness back below recent lows at 63.47 and towards that 2015 multi-year low at 61.30 further down. SPX 500. So the S&P 500 is now rallying out from recent multi-month lows at 1811 after the market had taken out the critical August 2015 low at 1834 the other week. At this point, there is room for this correction to extend higher, though any rally should be very well capped now into some previous support, now turn resistance at 1993, with a lower top sought out, now that the market has broken down below that August low, signaling a major structural shift. Gold. So a big breakout in gold this week after the market rallied above 1112, which had been some strong previous resistance. The break confirms a higher low in the 1070 area and opens the door for the next major upside extension towards 1192, that high that we saw back in October of 2015. At this point, any setback should be very well supported above the 1080 area, while only below 1070 would compromise the outlook and take the pressure off the top side of this newly adopted bullish outlook for the gold market.